It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Treasuries edge higher while stocks and futures are flat as traders brace for U.S. earnings season. Gold surging to fresh records. President Biden declares the U.S. commitment to defending Japan and the Philippines is ironclad amid concern about China's actions in disputed waters. Also ahead, stories of million-dollar salaries and 50% pay hikes for India's finance professionals as banks hunt top talent amid a booming economy. And we're set for the scene for India's elections beginning next week with insights from a leading pollster. Let's get you to markets. Asia not quite riding that momentum in the U.S. MSCI flat as traders recalibrate expectations of Fed rate cuts. U.S. PPI, by the way, a tad softer than estimates, still running quite hot there, adding to worries about U.S. inflation. Meantime, Korea, Singapore, standing pat, pretty much expected. Take a look where we are in terms of the MSCI Asia-Pac index, flat there, and the dollar index currently flat at 1.251. In terms of CSI, it is lower. Yuan, yet another strong fix. Offshore yuan has been rising versus the USD pretty much 4 out of 5 trading days. The strengthening is due, of course, by the PBOC's fixing. Japan, in terms of the Nikkei, it is getting a lift boosted by a surging real estate sector, buybacks, higher ROE among the issues that are being brought up to us. In terms of yen intervention, yen steady after breaching 152, going all the way to 153. If you recall, yen currently trading, let me take a look where we are at this point in time. Well, the yen at 153.17, waiting for intervention there. Well, monetary officials from both the U.S. and Europe making it clear that they're not in a hurry to cut rates. Boston Fed President Susan Collins says it may take more time than previously thought to gain the confidence to begin easing policy. Meanwhile, European Central Bank Chief Christine Lagarde refrained from speculating much beyond a prospective move in June.
We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level of and duration of restriction, and we are not pre-committing to a particular rate path.
The recent data have not materially changed my outlook, but they do highlight uncertainties related to timing and the need for patience, recognizing that disinflation may continue to be uneven. And this also implies that less easing of policy this year than previously thought may be warranted.
Well, for more on central banks, we're joined by Thomas To, head of APAC iShares investment strategy at BlackRock in Hong Kong. Tom, I mean, so much for 2024 being the year for disinflation. Looks like disinflation is dead. The narrative suddenly has changed, hasn't it?
Well, suddenly and not so suddenly. I mean, yes, you know, where we are in terms of inflation numbers, growth, and particularly on the expectation for rate cuts has shifted dramatically. I mean, if you think about January, if you're an asset allocator and you're kind of predicating your entire asset allocation on the fact that we're going to get multiple rate cuts in the U.S., inflation is going to come down and how that impacts your portfolio, you know, that's shifted so dramatically now. It's, you know, there's a lot of confusion about what to do in this environment. Do you kind of shift away from your original asset allocation, or do you kind of stick with it here?
Well, the thing is, we've gone from 7 to 3 to 2 now. Some suggesting perhaps a rate hike may be in store. I mean, is that even a possibility?
Yeah, don't say that. I don't think it's a possibility. But you know, certainly if inflation continues to pick up and is sticky, you know, you could have a possibility where you get two rate cuts, and then, you know, into next year we get a rate hike. I think, you know, there's obviously a lot of confusion at the moment. But, you know, what we've been saying all along is, you know, inflation is sticky. The path to 2% is very, very difficult. And now you kind of have this divergence between central banks where, you know, there's a lot of central banks in Asia that are looking to cut rates outside of Korea and Taiwan and Japan. And then the ECB likely going to cut before the Fed now, which is a new shift. So, I think the country allocation, asset allocation, is very important at this point because it's not all going to be driven by the Fed as it was the last couple of years.
Is there a sense we might be headed towards unsynchronized central bank monetary policy?
It certainly seems that way. I mean, we've had the Bank of Korea, the Taiwan raised interest rates, ECB standing pat, RBA looks like there is a possibility of a rate hike there. So, yeah, I mean, the inflation dynamics across the globe are very, very different. And so, I think central banks will obviously have differing policy moving forward. I think global growth is still slowing to some extent, not as much as probably anticipated at the start of the year. But yeah, I think central banks are going to be driven by their own country dynamics rather than what the Fed are actually doing at this point.
Tom, hang tight. I'm going to bring in my colleague Swati Pandey here, who joins me in Singapore. Swati, we talk about how, the BOK stood pat, MES stood pat, pretty expected given that everybody's waiting on the Fed.
That's right, especially after U.S. inflation came out much stronger than expected. And the rate pricing for Fed has also pulled back. I don't think any central bank in Asia would go out there and say we are ready to cut interest rates when inflation uncertainty still remains the buzzword. In fact, when I was in Singapore in January and I met with a bunch of investors, at the time there was a lot of optimism and people were talking about how we are going to see interest rate cuts in 2024 and the economy is going to turn around. Second half of 2024 there was a lot of positivity around there. And this time when I'm meeting with people, uncertainty is what everybody is talking about.
In fact, when it comes to the BOK, Governor Rhee did say just today that it's hard to prejudge the possibility of rate cuts even in the second half.
Yes, that is true. It is very hard to predict what inflation is doing. I think central bankers themselves are very much surprised, astounded at the stickiness of prices and also the resilience of their respective economies. We are seeing that in Australia as well. Economic growth has slowed, but inflation remains sticky. It still remains concerning and does raise a question over whether central banks have done enough to bring inflation down.
And Tom, given such a scenario where there's so much uncertainty, where we talked about the possibility of unsynchronized central bank policy, where are the opportunities? Where do you put your money?
Well, as I said, in terms of the single country risk, I mean, the obvious ones for the long term are still Japan and India. In the short term, we moved slightly more neutral on Indian equities given some of the valuations and obviously upcoming elections, et cetera. But, over the long term, India, great growth engine of Asia. Japan, slightly different dynamics, but, a lot of pushback on Japan given the kind of the consensus tag that it has at the moment. From what we're seeing, we still see foreign investors underweight Japan. And that's even before the actual domestic investor gets involved. Huge amounts of money, $7 trillion US sitting in cash and deposits there, waiting to be deployed as the inflation picture picks up. So, Japan, I think, also a good diversifier in the fact that they really want inflation. Everyone else doesn't want inflation. So, yeah, Japan and India on the single country, and then obviously there's still a lot of yield you can get in the fixed income markets, target maturity type of bonds. And on the sectors, rotating, again, maybe taking a little bit of rotation away from tech and into some of the slightly more safe haven consumer staples, et cetera, as we move into not only a higher inflationary regime, but also some risks around U.S. election into the second half of the year.
And Thomas, we cannot let you go without talking about China. What are your expectations? What's happening there? And also in terms of investment flows, what's happening with Chinese equities? Yeah.
I mean, sentiment is still really poor towards Chinese equities at the moment. I think on the positives, we have started to see some inflows back into Chinese equities, both through Stock Connect and also through ETFs. I think where foreign investors are now, it's not that they're incrementally positive on the growth of China, particularly on macro level, and also the fact that earnings growth has been so poor there. But I think investors don't want to be too underweight in case we start to see a bit of a pickup in earnings, inflation, and the macro level. So I think, where we are now is, in terms of my views on China, very similar to the start of the year, very much a trading environment. Investors are looking for liquid offshore type of exposures to raise underweights slightly, but I don't think the sort of the 6 to 9 month view is incrementally positive at the moment.
The issue right now for China and a lot of the other markets as well, and in terms of their currencies, is USD exceptionalism, Tom. I mean, how much longer will the USD stay strong, and what do you make of the currencies around the region?
Yeah, I mean, it certainly looks like U.S. dollar strength is going to be with us for a little bit longer until we get some more data around inflation coming down in the U.S. And what other central banks are going to do. I mean, if the ECB are going to move first, then obviously that's going to create a little bit more tailwind for the U.S. dollar. I do still expect the BOJ and JPY will appreciate this year. A lot of testing of the mettle of MOF as to when they will actually intervene. But I think that the move on JPY recently is being driven more by the pickup in yields in U.S. 10-year rather than anything specifically in Japan. JPY futures positioning very, very stretched on the short side from foreign investors. So I think if the MOF did move, we would see some pretty sharp appreciation. But for the moment, it seems like that 150 level is kind of where we're going to be for a little while.
When do you see MOF moving?
Well, everyone's now talking about 155, which you can put as much stock into that as you want, because everyone was talking about 150 and then 152, and it didn't happen. I mean, the MOF have come out probably 20 times in the last few weeks talking about verbal intervention. I think they're a little bit wary of moving at this level, given that the JPY has been driven more by U.S. 10-year rather than anything domestically. But certainly, this level is much weaker than they would like on the JPY. And when they significantly moved in October 2022, there was obviously a very sharp appreciation. But then with U.S. 10 years moving higher, we were kind of back to the same levels of high 140s as we were before the intervention. So I think they're very wary about when they actually move, but I think it will probably be coming relatively soon.
Thomas, I want to ask you about China-Australia relationships. The relationship has improved recently with the final tariff on wines lifting as well. Are you looking at any China-exposed stocks in Australia, like Australian-listed stocks that are exposed to China as a place to invest?
Not really Australia-specific. I mean, in terms of the China theme, looking for China exposure outside of China, most investors have been looking more towards Europe. And as I said earlier, when investors are actually looking at the China story, I think at the moment it's not so much stock sector specific. It's more about how underweight are we in the portfolio? What are the risks to the upside? And if we want to put some more China exposure to work, where are the liquid exposures that we can use in the ETF world? And I think that's more in offshore as a whole at the moment, as opposed to taking specific stock or sector bets.
Bloomberg Economics reporter Swanti Pandey there. Thomas Toh from BlackRock is sticking around. Now, still ahead this hour, with almost 1 billion people registered to vote, India's 6-week-long general election is set to begin next week. Public opinion and stakeholder research agency See Voter will be joining us for a preview shortly. Plus, how India's top traders are cashing in on the booming economy as banks battle for talent. Keep it here with us. This is Bloomberg. Welcome back. We're awaiting China trade data today. Of course, meantime, we have the Hang Seng as well as CSI 300 index under pressure. In fact, the Hang Seng is down about 1.5%. It is slipping, heading for a weekly close below that 17,000 threshold, which would send a negative signal pretty much across local stocks. It would be yet another example of Hong Kong lagging behind other major equity markets. In terms of the Shanghai Com, it is flat at this point in time, 30.35, and the CSI 300 in negative territory, down 0.2%. Yes, we're awaiting that trade data. We're also awaiting that China GDP data due out next week, and if that data doesn't bring any injection of positivity, well, investor sentiment will fall even more. Let's get to Thomas Stoll, head of APAC iShares investment strategy at BlackRock. He is still with us. Tom, of course, we've been waiting for, stimulus out of China, and that's not coming in a big way, the kind of big way that we're anticipating.
Yeah, I mean, it kind of seems to me like we're in a little bit of a bad news is good news and good news is bad news situation with regards to what the PBOC will do. I mean, I think where we are now, their expectation of 5% GDP growth this year, I think is still attainable. But I think there still needs to be some tweaking in terms of policy. But when we start to get better trade data and better inflation data, et cetera, actually the market tends to drop because that kind of lowers expectation that we'll get some kind of liquidity into the system from the PBOC. I mean, the state funds have been buying equities and ETFs, but clearly that's not quite enough to move things further.
FX traders in particular, Tom, they're not convinced. I mean, it's been taking a lot of strong fixes to actually support the yuan. Without that fix, Tom, I mean, where would the yuan be?
I have absolutely no idea. I suspect it would be somewhere around 8, but who knows? I mean, that's the thing with fixed currencies. Obviously, what are the reserves that you have to actually stick to that level? But the market is clearly fighting to further depreciate the CNY. And again, until something materially changes, I mean, that's the trend that we're in at the moment. Plus, you have stronger U.S. dollar, which doesn't help particularly.
That's right. I mean, and in terms of the USD and U.S. economy, we have earnings season starting to kick off as we speak. I'm just wondering what your expectations are.
Well, I think not as optimistic as the market is. I mean, if you look at the EPS expectations for this quarter and this year, very, very optimistic. Now that we're starting to price in fewer rate cuts, you start to see this shift away from some of the smaller caps, which had been seeing some pretty significant inflow as a lot of investors started to think that the bullishness in the economy was going to widen out into some of those small caps. That won't be in Q1 earnings reports, but maybe moving into Q2 and Q3. A lot of questions on what can derail the U.S. exceptionalism. It is probably around earnings growth because, right now valuations are quite pricey. But if earnings continue to come through, then those ratios come down. And it's the exact opposite in China. Things are looking very cheap, but if earnings continue to fall, then obviously the valuations look a little bit more expensive.
But it's really about the Mag 7 and whether valuations can be maintained for the Mag 7. They've lifted, for instance, sentiment generally across the board for the U.S. I mean, can the likes of NVIDIA maintain the kind of numbers that we've seen so far?
Yeah, I mean, I don't really know, but certainly if you look at some of the EPS projections for those Mag 7, they are extremely high. And so when we look at some of the concentration risk in the U.S. market and how investors are positioned, the upside risk to a beat versus the downside risk of a miss, I think probably for my own portfolio allocations, I'd be kind of not going too overweight on some of those Mag 7 stocks into this earnings season. But they continue to beat. So until that shifts, then the investors are going to continue to play those names.
Taking a look where we are right now, Tom, it does feel like financial conditions need to tighten even more for the Fed to rein in inflation. Eventually, what will that mean for stocks? Surely they will be under pressure.
Yeah, I mean, it depends, obviously, how far they go with regards to if there's no rate cuts or there's one or two or whatever it is. But, I think the misconception here is that if the Fed are more hawkish than was previously anticipated, that, some of these tech names in Mag 7 will sell off significantly. And actually, it's kind of the opposite because, these are the names that have had all the profit and have all the cash to put to work. So they're kind of more safe haven type of exposures at the moment. Whereas if you look in the kind of the real economy, Russell 2000 type of exposures, these are the ones that actually, are having to borrow at these high interest rates and tend to suffer as inflation continues to pick up. They have much more difficulty in passing costs on to end consumers. So, if this situation continues with sticky inflation, earnings continue to be good for some of the mega cap sevens, then the trend will continue. But as I said, the issue really is around concentration risk, and it doesn't take much for investors to look to take profit on some of those names.
Tom, just one final question before we let you go. I mean, what's keeping you up at night when you take a look at the markets?
What's keeping me up at night? I mean, certainly, with daylight saving, it's a little bit easier to stay up for some of those CPI data. So, I think the one on Wednesday definitely it wasn't keeping me up, but it certainly made it hard to go to sleep after that one, given the big moves in yields. So, I think inflation is obviously one of them. I think U.S. election risk going into the second half of the year is definitely one of them. And then also, geopolitical tensions around that and how you hedge for those using things like commodities and gold, I think, are probably the three main things at the moment.
Amazing how fast gold has gone up. Record after record. Thomas Torr, BlackRock, we thank you so much for your time today. Plenty more ahead. Keep it here with us. This is Bloomberg. Some tech-related stories we're following. FTX co-founder Sam Bankman-Fried will appeal his conviction and 25-year prison term for committing a multi-billion-dollar fraud. The 32-year-old filed a notice of appeal in federal court 2 weeks after his sentencing. It's unclear on what grounds Bankman-Fried intends to appeal. Apple shares climbed in New York after Bloomberg revealed the company is preparing to overhaul its entire Mac lineup with AI-focused in-house chips. Sources say it's already nearing production of the next generation M4 processor. The new chip will come in at least 3 main varieties, and we're told Apple is looking to update every Mac model with the technology. Let's take a look at how Apple suppliers here in Asia are reacting on the back of that Apple news. You have Samsung Electronics under pressure, down 0.5%. TDK, Taiwan Semiconductor, though, in positive territory. In fact, TDK up by almost 2%. Then again, we are having people say that Apple already nearing production of the next generation M4 processor. We're also keeping an eye on Chinese chip stocks on the back of a Chinese minister urging the acceleration of integration of AI and industries. Gains across the board. Plenty more ahead. This is Bloomberg. Welcome back. China markets just heading to lunch. CSI 300 index under pressure, down 0.3%. Of course, we're awaiting that trade data coming out later today. Some say perhaps it's going to come in later than normal, 3 p.m. probably. And of course, that GDP data due out next week. Where CSI 300 index down 0.3%. The yuan, of course, front and center as well. Another strong fix. Offshore yuan has been rising versus the USD for 4 out of 5 trading sessions. And of course, that has to do with that strong fix from the PBOC. In terms of the yuan, it is at 723.64. As China goes to lunch, Japan comes back from lunch break. Taking a look where we are in terms of the Nikkei 225, it is getting a lift, boosted by a surging real estate sector, buybacks, higher ROE estimates, making them pretty attractive. In fact, the topics currently up by 0.6%. Topics real estate gauge up 4%, by the way, extending gains year to date to about 30% right now. In terms of the yen, 153.20. Remember, we're looking at intervention at 152. That intervention not yet coming now. People are saying expect intervention at 155. Let's get more. Bring in MLive strategist Mark Cranfield. The yen, oh my, intervention, when is that coming?
It's a lot to do with the speed of the movements. That's what we've seen in the past. The Japanese authorities haven't, and quite rightly, they don't give the market indications of specific levels. That will backfire, of course, because then traders would just know where those areas are and they drive the market straight there. So it's more about the pace of the movements. That's what we saw, especially in 2022. Dollar yen was going up too quickly, basically. Over a period of a couple of weeks, it accelerated something like 5%, which was, from the Japanese authorities' point of view, that was just too much too soon. This time around, we've, as you say, gone through 152. Some people are surprised by that. But if you look at what's happened in the past month or so, apart from this week, we haven't really seen a fast increase in dollar yen. It's been very gradual. So the Japanese authorities are probably relaxed a little bit. Not much they can do about the US side of the equation. You get things like US CPI data coming in above forecast. They can't control that. So, of course, people want to buy US dollars. They can only do from their own side. And so far, the Bank of Japan have been very slow to increase interest rates. So from here, it's really a question of the kind of pace that we've seen this week. If that accelerates again next week, certainly the risk of intervention becomes a lot stronger.
And you say if there is an intervention, they will intervene outside of Asia. Also linked to that, if you take a look at the Kanda model, what does it say about timing?
So one of the reasons why people are thinking that they will probably use the time zones in Europe or New York, they've done it before. It's been very effective. But it also tends to be where the biggest short positions against the yen tend to be. So the most active hedge funds tend to be in Europe or the United States. They've already built up very large positions. Currently, they're holding very big shorts against the yen. Also, we tend to see more momentum outside of Asian hours as well, typically around the time of US data releases. Now, our colleagues in Tokyo built this Kanda model. He's the man who's the most responsible for deciding when the Japanese authorities go ahead. He's the Mr. Yen these days in terms of the Ministry of Finance. And he, unusually, he gave a little bit more clarity earlier this year when he talked about a 10 yen movement. Now, that one seems to be the move between early December to February when dollar yen effectively went from 140 to 150 in a relatively short space of time. After that happened, he became very active and speaking regularly, telling traders, this is too fast. It's calmed down since then. If we follow that same kind of logic, actually the move looks as though 156 would be the kind of area where he would want to stop the yen from falling, because we dipped back to 146 against dollar yen. We're currently 153-ish. 10 yen in a short space of time would equate to 156. Whether that is the case or not, or whether he wanted to spring a surprise, who knows? But certainly, we're looking at higher levels.
Suffice to say, like you said, we're looking at higher levels. It is a weakening yen trend. I mean, what does it mean for other asset classes?
Well, it affects everybody, of course. I mean, the whole foreign exchange world is watching dollar yen. Chinese especially are very concerned about it because it affects the Chinese currency as well. And you can see they're intervening, or they're setting the fixing on a very strong level to try and reduce the volatility there. But then, of course, it affects bond markets as well. We've seen this week the Japanese yield curve has steepened quite sharply. Now, that's not just because of what's happening in US Treasuries. It's also a reflection of the Bank of Japan have said quite clearly that they will be taking into account the yen moves because of the inflationary impact. That means higher interest rates in Japan. So the Japanese bond curve has steepened quite aggressively because the Bank of Japan is watching. But on the flip side, it's very good for Japanese equities. Talking about the real estate sector today is up more than 4%. So several parts of the Japanese stock market are enjoying the weaker yen, but not so much the bond market.
All right, in the end, it is also about the Fed. You talk about treasuries. Yeah, it is about the Fed and where the Fed goes from here. MLive strategist Mark Cranfield, thank you. Now, the US, Japan, and the Philippines say they are committed to a free and open Indo-Pacific. The statement comes after a summit between the three countries' leaders following increasingly assertive Chinese actions in disputed waters.
The United States defense commitments to Japan and to the Philippines are ironclad. They're ironclad. As I've said before, Any attack on Philippine aircraft, vessels, or armed forces in the South China Sea would invoke our Mutual Defense Treaty.
Facing the complex challenges of our time requires concerted efforts on everyone's part, a dedication to a common purpose, and an unwavering commitment to the rules-based international order.
China's current external stance and military actions present unprecedented and the greatest strategic challenge, not only to the peace and security of Japan, but to the peace and stability of international community at large.
Strong words from the three leaders. For more, let's bring in our Manila Bureau Chief, Manolo Sarapio. Manny, what are some of the takeaways from this tri-led meeting?
Basically, I think the leaders, especially Japan and the Philippines, sought to boost defense defense and security ties with the U.S. and that's what they got. I mean, President Biden said he was committed to deepening maritime security ties with both allies, and I think it was quite interesting with respect to the Philippines that Biden said that any attack on the Philippine aircraft, vessels, or armed forces in the South China Sea would invoke the Mutual Defense Treaty between the Philippines and the U.S. Because previously, I think what he was just saying is any armed attack. So it was quite an interesting change, if you would call it, in terms of the wording there. And it was also quite interesting that the Japanese Prime Minister Fumio Kishida has pointed out that the world needs the U.S. in terms of playing this pivotal role in terms of securing global order, and especially towards Asia, given the tensions with China, not just between the Philippines and the China over the South China Sea, but between Japan and China over the East China Sea.
It's well and good that that the U.S. continues to back Japan as well as the Philippines. The question really is how far the U.S. is willing to go. I mean, from the perspective of the Philippines, what is its own understanding?
Basically, that's why the Philippines, I think, has been trying to adopt that stance that whatever China is doing, whether it's water cannoning, Filipino supply boat, or blocking its efforts to rotate and to supply military outposts in a disputed shoal in South China Sea. What the Philippines is doing is trying not to retaliate or water cannon back to the Chinese ships. But I think the U.S. is now quite clear in terms of saying that such is the commitment to the Philippines in terms of mutual defense treaty. It's quite ironclad that any attack on the Philippines would invoke that treaty precisely. And for the Philippines, as we have heard from Marcos during our interview last March, that the Philippines is trying not to poke the bear. Really, it's trying to be as calm as it can in terms of what it needs to do. It needs to rotate and resupply a military outpost that's been there for over a quarter century in the Second Thomas Shoal in South China Sea. But it's doing that hopefully and asserting its claims within its exclusive economic zone. But obviously, it's hoping that China would not oppose those efforts.
Manny, we know that Marcos is in D.C. for the second time in less than a year, suggesting deepening relationships between the Philippines as well as the U.S. What kind of cooperation can we expect beyond defense?
Actually, what they've been doing is not just, outside the defense ties, outside the rekindled defense ties, what they've been doing is the U.S. has been supporting efforts by the Philippines to boost its infrastructure. Right now, there was an agreement between the U.S., Japan, and the Philippines for an economic corridor in the main Philippine Luzon Island that will involve construction of rail, ports, modernizing ports, and boosting semiconductors plants, and it involves actually that corridor would include or would cover the two former military bases, Subic and Clark, which are now economic zones. And beyond that, I think there was also a grant by the U.S. To a Philippine mining company to help push the Philippines' bid to encourage downstream processing in its mining industry.
Many as much as Marcos is pushing back on China, China has a strong presence in the mining industry in the Philippines. How do you balance that relationship?
That's true. To be honest, actually, the Philippines, China remains the Philippines' top trading partner, and I don't think there has been a real effect in terms of the tensions in the South China Sea. I don't think it's spilled over such that it would affect the trade relations between the Philippines and China. For one, China remains the top market for nickel ore, which is the Philippines' main mineral export. So, and also China is a major destination for agricultural products like bananas. So I don't think we're seeing a collapse, if you will, of relations between China and the Philippines on the economic front. But what the Philippines is doing is it's trying to diversify its trading partners, countries that can invest in the Philippines. So when its relationship with China becomes more strained in the future, it's ready.
Manolo Sarapio, our Manila Bureau Chief, thank you so much for that. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, trepidation in terms of markets in Asia on the back of harder than anticipated data out of the US. Of course, traders repositioning and dialing back on expectations of those rate cuts in the US. MSCI Asia-Pac Index pretty flat at this point in time on the back of US PPI, tad softer than estimate, but still running hot, adding to worries about US inflation. Take a look where we are in terms of Hang Seng Index, now down about 1.7%, extending its loss for the day as well. Let's do a check on Indian markets. It starts trading right about now. Let's take a look where we are for the Sensex index and all the other benchmarks under pressure like the rest of Asia. Sensex down about 0.4%, losses for the rest of the benchmark. Citi, though, says India may see higher profit upgrades than the long-term average. That could be one to drive sentiment in that particular market. Now, top traders in the South Asian nation here, of course, we're talking about India, have never had it so good, with big banks scouring for talent in the booming economy. The employment market is so strong. Stories are circulating of million-dollar salaries and private bankers demanding 50% pay hikes. Asia stocks reporter Ishika Mukherjee joins me now with more on today's Big Tick. Wow, that's a massive uptick.
Absolutely, and the optimism is wherever you look, right? Foreign firms are expanding into India for the first time. The likes of BlackRock, HSBC, UBS, who left India in the mid-2010s, are coming back because of renewed prospects in the country. It's done a lot of work in terms of ease of doing business and getting rid of some capital controls that were really weighing on these businesses when they first came into India. And all that is concomitant with a pay hike, right? With salaries booming. So market makers at foreign and local firms are seeing desk heads of algo-driven strategies getting $1 million annually. And then you have private bankers who are jumping ship at a 50% pay hike. They're demanding no less than 30%, going up to 50% at times. And then you have employers who are finding that fund managers aren't turning up when they're supposed to on a Monday morning and just ghosting them and turning up at a rival fund instead. That really tells you how this is really the employees, this market right now.
But that's based on the assumption that this is a Goldilocks situation. I mean, there are risks to that.
Absolutely. And you can see that the Indian authorities and regulators are starting to, you know, go like, hang on, there's over-exuberance here and you don't want things to crash, right? So they've clamped down on IPO financing. They've clamped down on speculation in the currency derivatives market. They're also trying to get small and mid-cap funds to stop taking in new money because there's over-exuberance in that space for a lot of companies that aren't even profitable at this point. So they are taking steps. But at the same time, India is winning from, you know, the EMX China flows for sure. And this is a country that is expected to potentially overtake China as the growth engine of the world, right, by 2030, as our own story said. So there is over-exuberance in parts, but this seems like a structural trend for now.
Yeah, that's right. If money keeps flowing, what do you do? Absolutely. Right? You got to pay them. Asia Stocks reporter Ishika Mukherjee there. Now let's stay with India. The world's largest exercise in democracy gets underway next week. Nearly 1 billion people will be eligible to vote in India's general election, a process that will stretch over 6 weeks. To help us understand the mood of the electorate, let's bring in Yashwant Deshmukh, his founder director of the Center for Voting Opinion and Trends in Election Research. Good to have you with us. Give us a sense of, you know, the issues shaping this election.
Well, the biggest issue is Prime Minister Modi and his popularity itself. The kind of trustworthiness that he has gained among the electoral masses in India is unprecedented, because prior to this, there is only one Prime Minister in India. That was the first Prime Minister who actually won 3 consecutive mandates in a row. So it is unprecedented of sort that he is most likely to win a 3rd mandate, and also incredible in a way that in this is the 3rd election where every time he goes back to the elections, he gets even more stronger mandate from the previous term. So instead of any routine anti-incumbency, which is a stable electoral distinctive mechanism in India and in rest of the world, this time it is we are looking at a pro-incumbency sentiment where every time Prime Minister Modi goes to the poll, he comes back with an even better mandate. So that is pretty impressive and interesting.
The question is why, Yashwan? Why has Modi been able to do that? And this time round, is he likely to gain support, you know, from the southern states, which traditionally have voted opposition?
The thing is that he is a relentless worker in terms of political equity management, if I may say so. He knows very well that the South and some other states have now been very exciting towards him in terms of electoral prospect, but he has invested a lot himself in all those states, and he has been a relentless campaigner. You know, even the critics, die-hard critics of Modi, they have to concede that this person is a 24/7 campaign machine. He works hard and he goes around. I mean, not just in terms of campaigning, but he works hard in terms of delivery of governance, and then he goes around campaigning around that. So I guess that's more important than anything else. It's the trustworthiness of Prime Minister Modi, which is working for his party primarily, and that's something which is very unique. You know, it's not that India is not known for very impressive opposition leaders. There are very impressive opposition leaders at the state level. But when you talk about the national alternatives, it's the last 10 years of governance, the things that he has provided for, the things that he has planned and had shown the vision to a common Indian, which in our trackers, by the way, have been saying that everything is not rosy. But they hope for a very good future, the kind of future they are investing in.
What's the state of the opposition? Some say that this is a crucial election for the opposition party Congress to show that it remains relevant in Indian politics.
Well, in the last 10 odd years, barring the second phase of post-COVID scenario, there were only 3 months where Prime Minister Modi's popularity rating or satisfaction rating actually went below 50%. Otherwise, in the last 10 odd years, his satisfaction ratings have been always 50% plus. And when you compare that to the main opposition leader, Rahul Gandhi, he still struggles to cross 20% in that way. So I guess the main problem of the opposition alliance is the dwindling fortunes of the Congress party itself. And the main problem of the Congress party is the dwindling popularity rating of their main, family, which has been at the leadership helm of the Congress for almost like 7 decades. So that is where, in a very, very presidential form, this thing is not picking up for the opposition.
Yashwan, if Modi is so confident, if BJP is so strong, why is there a need to clamp down, intimidate, and even put opposition leaders to jail?
Well, that makes many people curious, even in the public opinion. In our trackers, a big number of people have been saying that a lot of agencies have been, politically used, quote unquote, in that way. There is a disapproval for that kind of using of the agencies. But there are two different things here at play. There is a disapproval for political use of these agencies, but there is hardly any sympathy for the opposition who have been at the receiving end of these agencies. So that's the big difference. It's not like they are getting a huge sympathy wave out of the uses of central probing agencies against their disproportionate asset or the corruption cases. So there is one sentiment that the agency should not be misused, but there is another sentiment which cultivates into sympathy for the opposition leaders. That is absent.
Yashwan Deshmukh, founder director of See Voter, we thank you for your insights. Plenty more ahead. This is Bloomberg. Noon here in the Lion City in Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Treasuries edge higher while stocks and futures are flat as traders brace for U.S. earnings season. Gold surging to fresh records. First quarter reports from the big Wall Street banks begin rolling in later Friday, with investors focusing on whether they can maintain momentum. Chips making headlines too. Apple revamping its Mac lineup with in-house AI processors, and Samsung set to unveil a $44 billion investment in the U.S. First off, the markets. Annabelle Drulis is on top of that bell.
Thanks, Az. Yeah, we're just heading into the midpoint of the trading session here in Asia today, and a couple of different themes you want to pick up on in particular. Firstly, just tracking those moves we've got in bond yields here again, edging a little bit high, so that theme across the week, even though we had that US PPI data coming through overnight, offering some comfort to investors. Still, it has that repricing we've seen in that pushback of expectations for when we're going to see the Fed finally cutting rates. So that's the sort of play that we're seeing here in the sovereign bond space, also playing out across what we see in the FX markets as well. The Korean won is standing out here, that weakness coming through for the currency. We actually had a BOK meeting earlier today. The central bank in Korea electing to keep its key rate unchanged. That was a decision seen by every single economist that we surveyed. But still, the BOK in its press just in the last couple of hours saying it is open to a rate cut if they do start to see inflation recede in the second half. Equities-wise, actually overnight on Wall Street, we did see some optimism coming through, particularly for big tech. It's not really translating across the screen here today, so perhaps a little bit of wait and see, because we're also approaching earnings season, and we've got the big US banks kicking us off later today. JP Morgan, Citibank, Wells Fargo, they're all on the docket for later today. commodity space, the one to track is actually what we're seeing in gold so far. Let's change on, take a look at the price that we're seeing here, because gold hitting a fresh record high in the session here. That is leading to more optimism coming through into the Chinese gold miners. They have really been on a tear, but we've really talked about all the different directions. What is behind the moves that we're seeing in gold? One of the factors being attributed to it is just the level of buying from central banks, and the PBOC chief among them.
That's right, and haven play as well as geopolitics come into play. Belle, thank you so much for that. Now, monetary officials from both the U.S. and Europe making it clear that they're not in a hurry to cut rates. Boston Fed President Susan Collins says it may take more time than previously thought to gain the confidence needed. And the ECB chief, Christine Lagarde, refrained from speculating much beyond a prospective move in June.
We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level of and duration of restriction, and we are not pre-committing to a particular rate path.
The recent data have not materially changed my outlook, but they do highlight uncertainties related to timing and the need for patience, recognizing that disinflation may continue to be uneven. And this also implies that less easing of policy this year than previously thought may be warranted.
Well, for more on markets, let's bring in Moody's Analytics Director of Economic Research, Katrina L. Also joining us is Bloomberg's Executive Editor for Asia Markets, Paul Dobson. Katrina, let's start with you. I mean, well, we got it so wrong. We went from 7 to 3 to now 2 and some perhaps none at all. I mean, your thoughts on the data that we've seen so far and the repricing we're seeing in the markets?
Well, I think when it comes to the US, it's very clear that the Fed is going to take a very patient and cautious approach when it comes to potential easing of policy. We have dialed back our expectations for when we do see the first cut. We're expecting that it will come in September and then possibly one more in December. I think that the data just doesn't support a more aggressive pullback in this restrictive policy at this point. We've got still elevated CPI, but also importantly as well, the labor market is holding incredibly tight, and that's also feeding through to the underlying strength in domestic demand and also underlying inflation as well. And I think the Fed is very cognizant of these data points, and so they're not, wanting to move more aggressively than potentially only seeing 50 basis points worth of cuts this year.
Katrina, you've gone from 3 to 2. What are the chances you may go to 1 or 0?
I mean, at this point, you can't rule anything out, right? And what we're seeing from central bank officials, including the Fed, is that they're really being guided by the data. There's no clear set path here. They are looking at what's happening, and, odds that we might see even more pullback in how many rate cuts we do see this year is high, unfortunately.
And Paul, of course, we saw a major repricing in treasuries. In fact, 2-year yields just under 5%. I mean, is it justified?
Yeah, well, it's definitely been a pretty painful week for investors in fixed income. Right up until the start of this week, we've seen plenty of buying interest around those 4.5% levels in the 10-year Treasury. But we've blown through that and kind of eviscerated some of that as well, with the market really pricing out pretty much a whole cut just in the space of 1 week. But it does feel like maybe the market was a little bit slow to really wake up to what was going on. The Fed policymakers have been telling us it pretty noisily already. And, it's just a question of really seeing that data with it all crystallizing around the CPI number that really triggered that move. That said, it didn't create the kind of turbulence you might expect across the rest of markets, despite that big move backwards in the Treasuries market. Repercussions for us, kind of interesting. Our dollar, your problem, the fight back from the PBOC in particular, drawing that line in the sand, and then the Bank of Japan having to grapple with the weakening yen as well. So, I think the repercussions for us are almost as interesting and important as they are for the Treasuries market as well.
Exactly. You've got to wonder what central banks in this part of the world will be doing. We had Indonesia all set to cut rates, and now it's holding back because of pressure on the currency. How is this shaping the thinking in this part of the world?
Yeah, well, I think that's it. All of the central banks are going to have to take into account what's going on with the dollar and what that means for their markets, and also what's going on with inflation. On the one hand, you do have some recovery in industrial production and manufacturing output exports. You do have commodity prices showing some recovery signs as well. And you've also got that kind of Middle Eastern factor, which has been buoying oil prices recently. On the other hand, central banks would like to be able to stop hiking and start cutting again. And so wrestling with that kind of dilemma, being stuck with over high interest rates in order to prevent too much currency weakness and an inflationary environment is making it very awkward for a lot of them.
Katrina, let's bring you into this conversation. I mean, we talked about how USD exceptionalism is putting a lot of pressure on Asian currencies. And, central banks here are now back to worrying about what the Fed may do and where inflation is going to end up.
Oh, definitely. And I think they were always closely watching the Fed. And I think it was hoped that, the Fed would start to cut around June, and that would provide relief for, or the opening the door really for central banks over in Asia Pacific to start easing. But what we've seen is that, obviously with Fed rate cut bets being pushed out, that is bringing that currency weakness really back into play. We saw it from the yuan today when the Bank of Korea did signal that they were holding rates. And so I think it's an ongoing story. And I think that currency weakness is going to remain front and center because of the addition to imported inflation that it brings, because in this part of the world as well, inflation is clearly not back to central bank target ranges in most places. It is still above comfort levels, and now with that ongoing renewed currency weakness that we're seeing, that imported inflation is coming into play. Unfortunately, at the same time that we're seeing elevated energy prices are up about 10% in the past month. That's significant. And if producers do have that ongoing pricing power to pass on those higher input costs to the consumer, we might actually see that renewed risk to inflation come up again.
Which countries are most at risk? Would Indonesia, for instance, with its subsidies, be it?
I mean, it's hard to pinpoint one in particular. I mean, what we're looking at, across the range, particularly in Southeast Asia, there are significant risks there. I mean, we've seen that, other economies like Singapore, for instance, that are heavily reliant on imported fuel and food as well. They're another one that is really at risk of this higher imported inflation, kind of derailing expectations for easing later in the year. Indonesia, with its fuel subsidies, as you mentioned, is certainly there. There's others as well that no economy in Asia is really immune to higher energy prices and then that risk of inflation resurging, unfortunately.
And so, Katrina, to put you on the spot or to drill down on that just a little bit more, do you think that, kind of 6 months down the line, we will have been able to ride it out in Asia, or do you think it's all going to end in tears?
I mean, the expectation and the hope is that we will be able to ride it out, but I think a lot does depend on what happens with energy prices. I mean, Russia's invasion of Ukraine early in 2022 really crystallized just how important energy prices are to shaping the global economy, and in particular to shaping monetary policy making across the globe and, of course, in Asia Pacific. So if we can see some sort of receding in energy prices, then I think that's a positive, and I think that will give central banks across the globe, including the Fed, but also here in Asia, a bit more breathing space, because we should see inflation continue to recede. But if we do see that resurgence, then I think that will be problematic, and then there could be tears under that circumstance. But that's not our baseline circumstance.
Katrina, trade data out of China today, GDP data out of China next week. Deflationary pressure still the issue for China.
Oh, definitely. I mean, what we're seeing in China is that domestic demand is still incredibly weak despite policymaker efforts. They've been targeted efforts, but there's still been stimulus on the monetary front and also the stimulus front as well to try and reinvigorate domestic demand. But we're just not seeing that come through. Households are just not out there spending as exuberantly as we would have expected them to be in the absence of COVID policies no longer being there. What we're seeing as well is that private investment is still incredibly weak. But I think think more critically that the property market is still correcting. Forward indicators are pointing to ongoing correction, and it's unfortunately was this huge growth driver of the economy. And unfortunately, you know, the industrial side of the economy isn't roaring back to help pick up the weakness in the property market at this point.
I find it really interesting what you're saying there, and that creates this kind of really polarized sort of worldview where you have, you know, the inflation that's going on in the US and the higher bond yields and pressure in that direction, and in China, the disinflationary kind of impulses and the lower bond yields, and that's creating that really huge pressure now that we're seeing on the yuan. How do you think that the PBOC is going to manage those currency risks and get through this?
Yeah, it's a really interesting question, and I think what we're seeing from the PBOC is a concerned effort, and I think we will unfortunately see ongoing weakness when it comes to FX in China. But I think what's really interesting as well is when we actually dig down into the inflation data in China. I mean, headline inflation is contracting. If we look across the first quarter, it was actually flat. But you know, core inflation, so if we're excluding food and fuel prices, it's doing a little bit better. It's almost at 1% year on year, which is you know, better than what the headline suggests. And what is, you know, causing a lot of that when the headline weakness is, of course, pork prices. They do have that abundance of supply, and so that's contributing to it. But you know, underlying inflation pressures are actually showing a little bit of signs of improvement. It's still not fantastic by any stretch of the imagination, but it has improved. So it does give us a little bit of hope that domestic demand, although it's still weak, it's soft, but it is still kind of gaining some traction, which is a positive development. But because we do have those weak inflation pressures, it does give the PBOC that flexibility to at least provide some ongoing targeted relief, and that they will, you know, tread that very carefully because of the subsequent implications on a weaker FX.
Katrina, hang tight. Bloomberg's executive editor for Asia Markets, Paul Dobson, and Moody's Analytics Director of Economic Research, Katrina L., is sticking around. Now, still ahead this hour, investors gearing up for first quarter earnings from major U.S. banks, with JP Morgan and Wells Fargo among those reporting on Friday. IDC will be joining us for a preview shortly. Plus, Singapore's biggest property deal of 2023 said to have fallen apart. We'll look at what went wrong later this hour. Keep it here with us. This is Bloomberg. Welcome back. The U.S., Japan and the Philippines say they're committed to a free and open Indo-Pacific. The statement comes after a summit between the three countries' leaders following increasingly assertive Chinese actions in disputed waters.
The United States defense commitments to Japan and to the Philippines are ironclad. They're ironclad. As I've said before, any attack on Philippine aircraft, vessels, or armed forces in the South China Sea would invoke our mutual defense treaty.
Facing the complex challenges of our time requires concerted efforts on everyone's part, a dedication to a common purpose, and an unwavering commitment to the rules-based international order.
China's current external stance and military actions present unprecedented and the greatest strategic challenge, not only to the peace and security of Japan, but to the peace and stability of international community at large.
Well, let's discuss geopolitical risks facing markets with Moody's Analytics Director of Economic Research, Katrina L., who is still with us. Katrina, I mean, we've got to say that geopolitical risks have heightened, especially bearing in mind that we have the U.S. election at the end of the year as well.
Oh, definitely. I would say that geopolitical risk is one of the single biggest threats to the expectation that the global economy will improve and pick up in the second half of this year. I mean, if we see any sort of escalated tensions in geopolitical risk even further, I mean, we've already seen energy prices being aggravated by tensions in the Middle East. So any further kind of escalation could actually put the global economy on a darker footing. I mean, we saw Russia's invasion of Ukraine early 2022 really did change the whole expectation that we, around monetary policy and around global growth. And so, we can't, forget that learning. And so that is something that is continuing to threaten us now.
How would you assess the risk from the U.S. election and a possible Trump 2.0?
I mean, that's certainly a risk that is continuing to float around. What we're seeing is that, U.S.-China relations look very different under a Republican versus a Democratic government. We've seen positively in the past couple of weeks that relations between the US and China have thawed a little bit, which is positive. And we do know that when there are escalated tensions between these two powerhouse economies, it does lead the global economy down a darker path, because not only do we sometimes see trade restrictions, for instance, but it also does really knock global sentiment around. We know that businesses across the globe are already under significant pressure from elevated borrowing costs. Consumers aren't doing too crash hot either. And so if we do have this escalation of tensions, then, certainly it does really knock things off course potentially.
If Trump does come back to power, Katrina, do you see him pushing through with that 60% tax on Chinese products?
I mean, as an economist, I can forecast a lot of things, but I wouldn't even dare to forecast what a Trump administration can do. I mean, from an economist perspective, my hope is certainly that we don't see those sort of trade restrictions coming in, because they do really hurt economies, but they also hurt, in particular, businesses and eventually households as well.
You talked about oil prices. I'm just wondering, at what oil price would you have to reassess the projections you're making?
Yeah, that's a really good question. So our kind of rule of thumb is that any oil price that's, over $95 for a sustained period is actually consistent with a global economy going into a recession. So we're already dangerously close to that level right now, with Brent hovering around that $90 per barrel. So if we do see a further tick up for a sustained period, that's when we would kind of, reassess our expectations that the global economy has actually skirted a recession. And, it would send, I think what's been really interesting is that this year the narrative around global economic sentiment has been a lot more positive, because the expectation is that rate cuts would come. But what we're seeing now is, unfortunately, this combination of higher oil prices at the same time as inflation across the globe isn't quite playing ball. It's staying stickier than expected. And unfortunately, as a result of that, rate cut expectations are being pushed further and further out. So, this combination of sustained higher oil prices and implications for CPI do have us worried. And so that $95 per barrel is when we would definitely reassess expectations of a global recession being avoided.
Katrina, thank you so much for your time today. Have a great weekend. Katrina L., Moody's Analytics. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, here are some top global stories we're following. Morgan Stanley shares fell the most in 5 months after a report that U.S. regulators are scrutinizing the firm's efforts to prevent potential money laundering by wealthy clients. The Wall Street Journal says the SEC and the Treasury's Financial Crimes Enforcement Network have sought information on certain clients outside the U.S. who've raised red flags and on the bank's policies to address them. The Federal Reserve was already known to be looking into those money laundering controls last year. The largest U.S. airlines are asking the Biden administration to block new flights for Chinese carriers, citing what they call Beijing's anti-competitive policies. The Alliance for America Trade Group and several unions have made the plea in a letter to the Secretaries of State and Transportation. Flights between the U.S. and China are growing, but remain well below the average 340 per week before the pandemic. President Biden is moving to block oil and gas development in millions of acres of Alaska's North Slope with an initiative that could be finalized within days. The administration says it needs to balance oil development with protecting habitat for polar bears, migratory birds, and caribou. Companies with leases in the region, including Santos, ConocoPhillips, and Armstrong, have objected to the plan. We're keeping an eye on the yen, of course, breaching 152, pretty steady right now. It went as high as 153 and now at 153.21. Plenty more ahead. This is Bloomberg. Welcome back. You're watching Bloomberg Markets Asia, and we're going right back to markets. And Belle, of course, is about recalibration.
That's certainly been the theme of this week, and I'm actually just taking a look at the GMM function and just thinking about some of the things that are standing out. Firstly, you've got those yields continuing to move to higher, so that is that story again. Yes, the Fed perhaps pushing out rate hike or cut, rather, expectations, even some saying a hike could be the next step, but the PPI data overnight, of course, bit of relief, but that's still the main theme. You've also got those moves that you're seeing in the FX space. You've got the Korean won, for instance, under pressure. We did see the BOK electing to keep its key rate unchanged. You've got the Singapore dollar again there, a little bit weaker. We did have the MAS out with a policy statement, again, electing to keep its settings in place. So it's really just that wait and see. Central bankers, monetary authorities, they want to know whether inflation, price pressures, they're really coming under control. So patience, perhaps, is the other key word. What we're seeing in the stock space, again, it's pretty interesting moves today because we did actually have some gains on Wall Street overnight, and you're still seeing Taiwan, for instance, in the green today. But across the screen here, we're really in negative territory. And I'm looking at Hong Kong, the Hang Seng in particular, because you're below that 1700 mark. Which would be a negative sentiment to the rest of the regional markets here, which is also interesting to note because, again, taking a look at futures here, you can see Euro stocks, UK stocks as well. They're looking to some gains, so it tells you perhaps that optimism from Wall Street could skip Asia but then end up in Europe. Let's change on, take a look at some of the movers. One of the themes we're watching is that jump we had in Apple, for instance, overnight of nearly 5%. That was after we had a Bloomberg scoop out. Essentially, they're getting a new AI chip for their Mac lineup, so that is also helping some of the suppliers here in Asia. And then also just keeping an eye on some of those gold miners. We just mentioned those at the top of the hour, but worth noting today because we've seen gold hitting a fresh record, and that is really pushing some of those gold miners to the upside.
Well, speaking of going gangbusters, here's one stock we're tracking, Bharti Hexacom, making its debut today, surging as much as 35%. This is, of course, India's biggest IPO in a year. It is the telecom service provider. It raised $514 million to become India's largest in about a year, rising as much as 35% on its first day of trading, now up about 34%. Now, speaking of what we're keeping an eye on, investors gearing up for first quarter earnings from the major U.S. banks, with J.P. Morgan, Citi, and Wells Fargo reporting on Friday. Let's do a preview. Let's bring in Cyrus Daruwala, Global Financial Services Managing Director at IDC. Good to have you with us. We talk about an environment of higher for longer. It's great for banks.
It is. Well, I mean, as of right now, as we were saying, for right now, for the next couple of quarters, it looks pretty rosy. But we keep asking, how sustainable is this higher for longer? That's going to come to foray by the end of the quarter, end of 2 quarters maybe. So it's a bit of a short run. That's what I think.
But do you have to draw a distinction between the bigger banks and the smaller banks, which still have to make provisions for that higher T1 capital?
Correct. Now, the bigger banks had a relatively smaller exposure. In the larger scheme of things, you're looking at about 100 billion at the most. What happens to the smaller ones? Now, we've seen a couple of the smaller ones go under because of realty or real estate type exposure. The same thing happened with the Big Four or the Big Five in China. The impact in the US is predominantly for the smaller ones. So the Big Four are going to breeze through this quarter and even the half-year results. But I think the commercial real estate is going to catch up by the end of the year.
You talked about how there's clarity till the end of the year, but not so much in 2025 and beyond. If you were a longer-term investor, how should you be looking at it?
We are longer term, and I think we are a tad bit skeptical, not because of the sheer exposure that the banks have, but we are unclear with regards to what their growth strategies are. Now, Jamie came up and laid out a beautiful growth strategy. Jane, on the other hand, is fixated on cost cutting, and which is paying her great dividends in Citi. All of that, deprives us from a longer-term view with regards to what exactly and what is going to drive them. JP, cash management, global transaction banking, great. Goldman, predominantly around their assets and wealth management, great. How is Wells Fargo going to grow? What's Citi's call to action now that retail is gone or predominantly gone? So those are some of the questions we have for the longer term.
And here's another risk. Real estate loans. I mean, for 2024, we're looking at what, 900 plus, billion dollars. And that's a massive amount. You got to wonder whether that's going to transpire.
900 billion just in the U.S., I add. So commercial real estate exposure is tracking at about 920, 930 billion. That's now. Now imagine the Feds say this rate adjustment refraining has gone on for too long. They come in by October, November. Consumer spending is up. Banks are well capitalized, and they tamper with the rates. People, in turn, can't pay up the mortgages that are outstanding. So that 900 billion is the tip of the iceberg. Again, would it be as catastrophic as the 2008? I don't think so. But still about $1 trillion at stake is going to cause a significant dent amongst the Big Four, the Big Five.
Not to mention, we have seen this happen in China.
Yes.
Big Five, the top five.
Absolutely.
There is a possibility it may happen in the U.S.
It is possible. China wrote off 1.7 trillion last year amongst the Big Five. Yes, given that it's a drop in the ocean when it comes to the larger China market and all of its tickers, but for the U.S., it's a significant blow. Again, it calls a simple question. If commercial real estate is compromised, people aren't spending all that much, say non-farm payrolls are, balanced out, where will the Big Four in the U.S. grow? And if that is clear, we are okay with the longer run. If that is not very clear, and they're hoping for net interest margins to kick in again, that's not a good strategy.
Cyrus, we've been tracking flows. We've seen how money has flown from China to India, for instance, and we've seen how, the Max 7 have done. Is there expectation, or are we seeing that flow going from banks to technology, big tech in particular, as traders look for returns?
Absolutely, yes. You just said, the biggest IPO in India this year, it wasn't a bank, it was a telecom company. Some of the largest tech stocks, including, of course, the chip manufacturers, who are the apple of the eye for all the long-term investors, because, again, the sheer addressable market that you have there and the sheer growth propensity, plus there are 4, maybe 5 large producers. So tech stocks, and I'm talking not just the blue chips, not just Apple, Microsoft, and everybody else, you're looking at a huge amount of other tech stock. The NASDAQ has done exceptionally well. That's predominantly technology and solution-related stocks. So will there be a massive outflow? No, but will longer-term investors weigh out banking and financial services versus tech? I'll take tech.
All right, beware. Cyrus, thank you. Cyrus Daruwala, IDC Global Financial Services. Coming up, hear how the U.S. dropped the ball on its chance to take the lead in the technology underpinning the AI revolution. Stay with us. This is Bloomberg. Now to the battle for global supremacy in chip making. The US took a crucial early role in developing the technology that underpins today's AI revolution. But a Dutch firm now holds a monopoly in the process, while Asian manufacturers dominate production. Bloomberg Originals has been looking at how the US dropped the ball.
This is arguably the single most important machine in the world right now, technologically, economically, and geopolitically. Without it, the global economy would slow, the pace of technological advancement would stutter. They cost $200 million each, and of the 200 or so that exist today, just a handful are on US soil. What's more, successive US administrations have had to scramble to ensure that none are sold into China. And that's despite the fact that much of the early work on the technology originated in the US.
This is a story about where physics meets business and has a massive impact on the world's economy.
So how did the United States manage to miss out on this colossally important piece of tech? It's called an extreme ultraviolet lithography, or EUV machine, and it produces the world's most advanced semiconductors.
EUV technology is the only reason that we have iPhones that are as fast as they are, the reason that we have this AI revolution with chatbots and ChatGPT.
The device has turned the only company that produces it, the Dutch firm ASML, into Europe's biggest technology firm. Lithography is how circuit patterns are engraved onto chips.
This is a very, very important part of the process of making semiconductors.
The scale of extreme ultraviolet lithography machines is mind-boggling. Each device is the size of a bus, but is designed to etch patterns onto chips that are billionths of a meter across.
How they do so is a remarkable feat of engineering. A high-powered laser is fired at a tiny target of tin droplets about 50,000 times a second. That creates a plasma that emits extreme ultraviolet light, which has a wavelength of 13.5 nanometers. This light doesn't occur naturally on Earth. In fact, it's absorbed by most materials, including air. So the whole process is conducted in a vacuum, and a series of mirrors reflect and focus the EUV light. Each mirror is coated in layers of molybdenum and silicon and polished to a smoothness of less than 1 atom's thickness. That's important because any blemish reduces the quality of the chips being produced. Midway through this process, the EUV light is reflected by a reticle that contains the pattern of the circuits that are to be etched onto the chip. These are then reflected and focused even more to make the pattern even tinier before hitting the silicon wafer. Each wafer is etched with billions of such patterns.
The problem was it's so difficult to do.
The semiconductor industry is always racing to make things smaller, and its ability to keep doing that helps the global economy keep growing.
Now, some of the layers of materials that go into making semiconductors are 1 atom thick. You don't get thinner than 1 atom.
Semiconductors eventually faced a problem where they were really getting to the limits of the physics.
In the 1980s, scientists started to think that EUV light might be the best way to get to that atomic level.
The US government, through what are called the national labs, has always been helpful to the semiconductor industry at sort of underwriting some of these fundamental advances.
In fact, the Department of Energy ended up putting tens of millions of dollars into EUV research at 3 labs across the US. To make the jump from research to reality, an alliance was formed with companies including Intel, AMD, and Motorola. They'd match any government spending. In 1999, a little-known Dutch lithography company called ASML joined too.
Remember that in the 1990s, the Japanese were a major threat to US dominance of the chip industry.
The US government threw its weight behind ASML over the Japanese companies who were really leading in photolithography at the time.
ASML went all in. They reckoned the tech could be ready commercially by 2006.
EUV technology is really a moonshot. It was incredibly expensive and incredibly complicated.
By 2012, progress had been made, but more was needed.
It looked like EUV actually might be possible, but ASML actually needed lots of investment, so they turned to their customers.
TSMC, Samsung, and Intel decided, wow, this stuff is really important. We better put some billions of dollars behind it to make sure it actually happens. And Intel was the biggest contributor to that.
It was really thanks to ASML's stubbornness that they took years and billions in funding to actually produce EUV technology as we know it now.
Finally, in 2017, ASML begins shipping the machines in meaningful numbers. But despite the billions of dollars of investment from American companies like Intel and the US government, the first generation of devices all went to TSMC and Samsung. And it wasn't because ASML didn't want to sell machines to Intel.
Intel thought that EUV was really important, but like its competitors, they saw the issues with it. That was a decision that they made, and it's a decision that cost them massively.
Essentially, the then CEO Brian Krzanich didn't think Intel could make EUV work profitably and would be fine without it.
Intel was the biggest company in town in the industry, dominated the industry for multiple decades. Everybody else was playing catch up.
This is the scale at which Intel and TSMC have been able to make chips. Both have consistently got smaller, but with Intel leading the size reduction. Until 2018, when TSMC overtook Intel for the first time. The reason was, at its core, pretty simple. TSMC was making chips with EUV machines, and Intel wasn't. Soon after, Samsung's Galaxy Note 10 smartphone hits the market, the first consumer device featuring chips made with the EUV process. Apple follows, but then there's a problem.
Huawei, which was the world's largest smartphone maker at one point, was buying chips from TSMC.
The fact that Chinese device makers were making some of the most advanced smartphones caught the attention of the American government.
Huawei is something that's very dangerous. You look at what they've done from a security standpoint, from a military standpoint, it's very dangerous.
One of the ironies of EUV is that a lot of the underlying technology originated in the United States, but the direct and indirect beneficiaries of that technology haven't really been concentrated in the US. You had a company in mainland China buying chips from a company in Taiwan using equipment made in the Netherlands.
This vital cog in the wheel was made by a company in another country, one that they couldn't directly control. So it took a lot of work by Washington to persuade the Dutch not to allow ASML to export EUV to China. The details of how ASML did not ship to China have really been a little bit obscure. All we know is that they state vehemently over and over again, we have never shipped EUV to China.
In 2012, Intel was 15 times bigger than Nvidia and almost twice as big as TSMC. That's when it first invested in ASML. But Intel's failure to move early on EUV has allowed a number of rivals to overtake it. Intel's growth has stalled as TSMC, and especially Nvidia, have boomed.
Intel's leadership team under Krzanich really gave away the keys to the kingdom, and that caused a knock-on effect inside Intel. Krzanich left, some of the other leadership was replaced, and there was kind of a scramble to get that company back online. And one of the conclusions that new leadership came to was, we need EUV.
We have a very strong partnership with ASML, and our plans to now stay on the leading edge of EUV usage are well underway.
That's Pat Gelsinger, Intel's current CEO. He's throwing the company's weight behind the next technology.
The new thing in the world of EUV is called high numerical aperture, or high NA EUV. To give you an idea of how important this is, Intel has been loudly touting to anybody who'll listen, they've got the first high NA machine.
There's a lot at stake. The US's leadership in semiconductors and the success of President Joe Biden's CHIPS Act, which has set aside $100 billion in subsidies for the semiconductor industry.
We will enable advanced semiconductor manufacturing to make a comeback here in America after 40 years.
Politicians have finally woken up to how important semiconductors truly are, and Intel's entire plan to turn the company around is predicated on the idea that they can actually get government funding to build semiconductor plants and become a leader again in semiconductor technology.
And subscribers can see that Bloomberg Originals documentary again anytime on the terminal and on Bloomberg.com. It'll be up on their YouTube channel later on Friday. Well, still to come, one of Singapore's biggest property deals of the year falls through after authorities reject redevelopment plans in a prime shopping district. More on that next. This is Bloomberg. Well, Bloomberg has learned a blockbuster deal to purchase a mall in Singapore's prime shopping district has fallen through. That's after plans for its redevelopment were rejected by authorities. Let's get more from real estate reporter Dexter Lowe. Wow, this is a huge deal. I mean, what happened?
Well, I think the reason for the deal's collapse was actually quite technical and quite boring in a sense. Basically, when it was purchased last year by this Chinese billionaire called Du Xianghua, basically there was only one plot. But there's this scheme in Singapore called Strategic Development Initiative, which basically requires that you have 2 plots in order for a redevelopment of this shopping mall. So this shopping mall has been around for quite a while. It dates back to 1974 when it was built. So it was one of the quite older malls in Orchard Road, which is quite a glitzy area. It's the main shopping belt of Singapore after all. So when the deal was announced last year, a huge deal, about $670 million US, it was the biggest deal of 2023 essentially, and basically there was quite a lot of excitement around the fact that it was going to be redeveloped. But the authorities basically said that because of the fact that it's only one single plot rather than 2, the government essentially said that that doesn't fit the criteria, and so it was rejected. And it was at a time that Tycoon Ray said, like, let's walk away.
I'm just wondering whether it has to do with the fact that it is Chinese money. Yes, 670 million USD. But, you know, given the fact that we've seen fraud cases in Singapore to do with Chinese investors, whether, you know, that could be one of the reasons about the hesitance.
I guess, in a sense, the government have not explicitly said that yet. And so far, the kind of explanations given by government, at least, is that there isn't actually any explicit reason why they rejected it because of the fact that it is Chinese money. Du is one of the kind of original Chinese tycoons that really made their fortune in Singapore real estate like quite a while back, even before the main money laundering case came to light. So I think there's a lot more scrutiny of the fact that scrutiny of Chinese money nowadays because of the fact because of the huge money laundering case. And certainly the amount of monies that we're talking about here is significant. So there certainly is scrutiny and saying there is a lot of concern about it. And when it was announced last year, it attracted a lot of eyeballs. So you can't, and certainly after the deal collapses, there's still this amount of money out there, which presumably has to go somewhere. So I think there's a lot of attention now where exactly will put this money now. We put it in Singapore, we put it elsewhere in other countries outside of Singapore.
Singapore would hate to think that it's going to say no to $670 million. What's next? What can be expected?
I think the question now is in 2 ways. So first of all, obviously that mall still has redeveloped. It's one of the oldest malls in Singapore, and one of the things that the government in Singapore has kind of put a lot of emphasis on this whole initiative, essentially that kind of spurred the deal in the first place, is that they really want to spruce up Orchard Road because after all, some of the malls there, compared to some of the more glitzy ones that we're seeing in recent years, are getting quite old, and because of the pandemic and other reasons, footfall has kind of reduced and hasn't really come back to what it was before the pandemic. So there is incentive to really buy the mall. So it'll be interesting to see which buyers kind of come forward to buy the mall. As for Du, I guess the question is, where will he put his money? Will he put his money in Singapore, where obviously the red tape and the kind of regulations seem to be a bit more tighter than it was before and a bit harder to kind of overcome? That's all kind of to be seen, and the market is certainly going to be quite interesting going forward in the next few months.
A lot more scrutiny here. Real estate reporter Dexter Lowe, thank you so much for that. Let's take you to markets. We're keeping an eye on Apple suppliers in particular on the back of Apple's plans to perhaps overhaul its Mac lines. We're looking at new in-house processes highlighting AI help drive a broad U.S. tech rally. Pretty mixed picture. Samsung Electronics down, but gains for TDK, TSMC, as well as Honhai currently up by about 1.7%. Quickly take a look in terms of treasuries, slightly higher in Asia after selling off overnight. They're in oversold territory. 10-year yields up 4 basis points. 2-year yields, particular in focus, inching ever closer to that 5% level. Will it breach 5? Well, let's wait and see. That is it from Bloomberg Markets Asia as Hong Kong and China are about to come back from lunch. Bloomberg Daybreak Europe is next. Keep it here with us. This is Bloomberg.